Okay, yeah, so let's do an example now. Okay, so if you open up the in-class Excel sheet, the first tab is 3-8, and you're basically given a situation where you have an asset, uh, computer equipment in this case. You're told what the useful life is. You're told what the residual value is, and your job is to calculate the monthly depreciation. So I'm giving you a hint, emphasizing monthly, not yearly, monthly. Okay, so you have to convert a yearly number into a monthly number. Okay, so think about how you're going to do that. And then record this adjusting entry at the end of the month. Okay, so take a minute, see if you can do that, and we'll do it together in a second. I see many of you got it. Okay, so look, uh, what we're doing here, again, we're basically starting. We basically have our graph of dollars in time. At the purchase time, we have 54K. At the end of 3 years, it's going to be worth zero. Our residual value is zero. We're going from 54,000 to 3 over 3 years. So we do 54K minus 0 divided by 3 equals what? 18,000 per year. So how do I convert yearly to monthly? What is that per month? Divided by 12. So 18K divided by 12 equals 1,500 per month. Agreed? That's going to be my expense per month. So basically, if I had 54,000, 1,500 per month, and if I did this down for 36 months, let me just prove this to you. This is my book value. So this is book value. This is accumulated depreciation. This is my expense. And this is my starting, let's just say. Okay, so now this is my expense every month, right? It's the same. It's a straight line method. It's the same amount of expense every month. The accumulated depreciation is just the balance from the previous period plus what is happening. So you can see here, this is just going to keep accumulating down, right? And then this book value is just equal to my starting balance, which is, let me just fix this. Okay, so now you can see it's reducing every period. It's just going down, right? My book value is going to go down. What is it going to be at the end of 36 months? What do I expect? What is my residual value? It should be zero. Okay, so let's just make sure that's the case. If I go all the way down, yes, it goes to exactly zero. Okay, so now I have, it's like trivial. Like the schedule is not really necessary because every period you're going to take the same expense. Okay, so um, what accounts are involved? What did I just calculate here? What is this $1,500? What does it represent? Depreciation expense. Yes. So I'm going to take an expense, just like any expense. It is debit normal. So depreciation expense and accumulated depreciation is the contra asset account. Okay, so this is May 31st. Okay, conceptual question. What is it going to be on June 30th at the end of next month? Is this is this journal entry going to change? Who thinks it's not going to change? Who thinks it's going to change? Well, will my journal entry change? The balance, okay, yeah, the journal entry is going to stay the same, right? Every month, I'm going to expense $1,500. Okay. Now, yes, this account called accumulated depreciation is going to change, but let's see what's happening. Okay. Accumulated every month, 1,500. This is from May 31, then June 30th. Okay. And this is going to go on for 36 months. Okay. You're going to keep getting 1,500, 1,500, 1,500. It's just going to keep accumulating. That's why it's called accumulated depreciation. So at the end of 36 months, my accumulated depreciation will be that full 54,000. That's why my book value is 0. Does everyone understand this? So this journal entry every month is unchanged, but this accumulated depreciation account, it keeps increasing. Every month it's going up. Okay? Make sense? So this is a big confusion for students. Depreciation expense and accumulated depreciation. They're two totally different types of accounts. Depreciation expense is an expense account. Every month it goes to zero, zero, zero. It starts at 0 at the beginning of every month. Accumulated depreciation is like an asset account. There's a running balance every month. Okay, so you need to make sure you're absolutely clear about that. That the expense account, depreciation expense, it just is going to be 1,500 every month, but the accumulated depreciation grows every month. Okay, well, we're going to see this in many different next chapter too. So, um, but again, the key thing to remember: expense accounts. You're going to learn this next chapter. They're called temporary accounts. They get reset at the end of each period to 0, so that your revenues and expenses for each year start at 0 on January 1st, and then they accumulate till the end of the period. Okay. Your asset accounts, like cash, like accumulated depreciation, like your van asset, they're going to roll over every year. They do not reset because it's not like your cash balance goes to 0 on January 1st, right? Or the amount you owe to the bank goes to 0, right? So there are certain accounts are permanent accounts. These are your assets, your liabilities, your retained earnings. Some accounts are temporary, they get reset. Your revenues, expenses, and dividends, they all start at 0 at the beginning of the period. So accumulated depreciation is a permanent account. It keeps growing over time. Depreciation expense is a temporary account. It gets reset. Okay, so you need to understand this concept or else this is not going to make sense. And you'll always just get the two confused. Okay, so think about it. If you're unclear by the end of class, then just come talk to me. I'll try to re-explain it to you. But just remember that an expense account is different and this is actually an asset account. Okay, accumulated depreciation is buddies with, in this case, like computer equipment. They go together, right? One is a contra account, it's a credit balance, and one is a debit balance. But they're both going to be reported on the asset side of the balance sheet.